Hello everybody, my name's True Demon and I'm the Devil's Stockbroker. Today we're going to recap the events of the market that just played out today, so let's get started. The market kind of turned around on us in a hurry. The market finally printed some clear reversal candles. For the last several days, especially last week, we traded a lot of chop in this area. I have now coined this the official middle finger pattern, which this one I'm determining that this is clearly a bullish middle finger pattern. So as soon as we had retraced to this level and consolidated to the downside here on what was on the 1 hour chart a descending wedge, which you can see. Let me clean some of this up. There's a lot of stuff here. There's just a lot of stuff here. There we go. And I'll get rid of this harmonic. We don't need that. Okay, that's a little better. So we've been trading down in this channel for some time. And after seeing that we had attempted to break out on a descending wedge a couple of days in a row, but failed to maintain due to gap downs each day, I was expecting a breakout at some point. Now we did have one more gap that I was expecting to make to the downside, where we would touch the bottom of this channel before we had made a recovery. So I was expecting something like a gap down to the downside and then another test of the bottom of this channel before we turned back around and then broke to the upside. But that's not what we got. Instead, we had a gap to the upside and we broke out of this descending wedge right here. And as a result, now we are closed above this channel. So now this channel no longer applies. We're going to be looking to start a new channel to the upside. This is basically fits with the seasonality pattern that I had called out based on Democratic midterm election year and the second year of first-term Democratic president's seasonality. I'll really quickly go pull up that seasonality chart. So here's the seasonality chart for the SPY over here on the right, and we're going to keep the overall SPY as clean as we can while keeping in mind this big megaphone pattern. So we are still playing a crash to the downside, but in the middle of these crashes, we do have these big rallies that we have to look out for, such as here and here and here and here. These little bull rallies come unexpectedly, and now that we've printed a lower low on the SPY, we had to at least acknowledge the possibility that a rally could come very soon. And with the latest rally that we've had, which saw us taking, what was this, like 20? Yeah, it was almost 20% gains, and now we've retraced down 20% the other way. So at this point, we've put in a lower low, and if you were to look at the MACD on the daily chart, you can see that we are starting to now consolidate, and we've put in a lower low on the MACD. So this is still a bearish pattern. However, we're due for some relief rally, and we can see that the RSI is now put in a higher low on this daily chart right here. So it's really small, but you can see, thankfully, due to the nice little color pattern, we have a higher low on a lower low. So we have a low here and a lower low here on the price chart, but on the RSI we put in a higher low. So that's bullish divergence, which I've been looking for as a confirmation that we've got some upside ahead of us. So now what is the trading plan? What are we looking to do? Well, I'm going to be looking to trade the middle of this megaphone pattern, and I'm going to expect to see the SPY make a rapid recovery somewhere up to the around the 380 level. 390 is possible, but it's kind of reaching. There is some resistance there's quite a lot of resistance for us there. So in my opinion, like 400 is the absolute maximum that we'll see the SPY return to, at least this year. So I'll place that resistance there for us. And another resistance at around 390. So keeping these in mind, let's go take a look at what seasonality tells us about October. We can see that we've had very consistent patterns with seasonality. We had a big drop from January to March, which you can see that matches up with the chart. I want you to pay attention to the red line. That's the second year new Democratic president, as well as the purple line, which shows Democratic presidential midterm election year. These charts correlate very closely together, and you'll notice that they're extreme moves between the red, green, and the purple lines on this graph show clear patterns of seasonality that coincide with one another. So we had the downside move from January to March, and then we had a very quick upside from March until April. So that matches with this move here. And then April diverged from this seasonality pattern. So April to May normally sees upside, whereas we actually sold to the downside pretty extremely through May. We had a small pop in the beginning of June, end of May, beginning of June, which that does coincide with this chart. And then for the rest of June, we sold off up until early July. We had the chop, which you can see that also coincides here. This bottom in June and July, and that matches up with our bottom here. And then we had the summer rally. So the summer rally is a pretty famous seasonal pattern. We had the move that saw us top up in mid-August, actually, right on the dot. And then we sold off for the rest of the month, just like you see here. Now we're here at the end of September, beginning of October, and this is where the choppiness begins. And then for the first half of October, we tend to see upside in the market. So considering that we had a low in the beginning of September and a new lower low at the end of September, which matches up with right here and right here, I'd say that we're correlating with seasonality very closely. So it only makes sense that for the next move up, we're expecting some bullish upside throughout the first half of October. So there's not a lot of room for us to run, but there's some chance to capture some profits to the upside here. And we've got a lot of patterns that are agreeing with this. We've got bullish divergence on the RSI. We've got the MACD crossover getting close to happening. And we see that the all of the moving averages have been chopping quite a bit around here. And the 50-period moving average is currently above the 100. So with all of these moving averages really close together in this area, this is pretty much where I expect us to hit our ceiling. So wherever we're trading at by mid-October, once we touch these moving averages, that's pretty much going to be the top of this rally for me. And I'll be looking to take profit on any long positions at that point. Going forward into late October and then up until early November, I'm anticipating some more downside that will take us into the holiday rally. So you'll take note that that last leg down in October, it stops right before the end of the month. And then we get a rally at the beginning of November, consolidation for pretty much the entire month of November. So a lot of chop can be expected. And then finally a rally. And this rally is consistent against all of the other patterns of this chart. So no matter what presidential election year we're doing, whether it's midterms, Democratic president, Republican, the holiday rally is pretty consistent up until the taking of profit right at the very end of the year. So at this time, what I'm watching for, as I said, was to take profit around the 390 level and then play the leg back to the downside where we will retest this low. Depending on how the market shakes up and what the macros are doing between, the Bank of England and the Fed. Right now, the Bank of England is pleading with all the central banks to pivot on their positions and reduce their tightening cycles, at least to stop interest rate hikes for the time being. So that is an appeal from an economic ally, and it's hard to say whether they will actually pivot, but I'm inclined to believe that there's at least a chance that they might, and that the market will likely assume a pivot is likely. So we may end up seeing the market pump in anticipation of that. Even if the pivot doesn't happen, the market may anticipate one, believing that it's a certainty, or at least try to price it in. And if the pivot doesn't happen, then, well, the market will get rug pulled very quickly. Some other things to keep an eye out on. This was pointed out by Boomer Assassins in the Discord, so shout out, my dude. Thank you for pointing this out. The different banks, especially Bank of America, Wells Fargo, JP Morgan Chase, and Citigroup, a bunch of bullish articles are being printed on all four of these banks. And this is very consistent with late-stage crashes, especially the 2008 Great Financial Crisis. Right before the Great Financial Crisis in the summer of 2008, that was right in this area, the talk started in June and July. A whole bunch of very bullish sentiment came in at exactly this point in time for the market. The big five banks, Wells Fargo, JP Morgan, Lehman and Bear Stearns as well, all these big banks on Wall Street were printing all kinds of bullish sentiment about their expectations. They rose their dividends, and a whole bunch of mainstream media outlets, including the Wall Street Journal, Washington Post, but they were all saying the same thing about all the banks were secure, they were highly liquid, and that they had great expectations for their dividends, and it was time to go and buy the dip. And, well, what shortly followed after was the massive crash that occurred that fall, and we saw companies like Lehman and Bear Stearns both go under. Most of the banks lost their asses. Bank of America gave up significant portions of their stock, and they barely held on, especially after they had acquired Morgan Stanley, who had sold a ton of credit default swaps against the mortgage-backed securities market, and they ended up having to cash those out to whoever bought the swaps, and it slaughtered their balance sheet. So Bank of America took a huge hit as well. JP Morgan Chase later acquired Bear Stearns and took all rights and basically wiped the bank off the face of the earth, but they own all the assets that came out of that bankruptcy. With all the banks now publishing all of this bullish news about how great things are and how their dividends are going to go crazy, I'm expecting there to be another rally for this dividend cycle for at least the next 60 to 90 days. And that would fit just about right with the bullish rally that we had during the Great Financial Crisis, or just before the collapse came. And then right as dividends had finally, the dividend from that quarter had printed, that was when the fall came. So we put in a top right on the ex-dividend date, and for the next 40 days gave up 33% of the stock market, and the SPY just completely collapsed. So I still think that a crash is coming, but I think that we need to go through one more of these relief rally cycles, most likely this sized one based on my comparison chart from 2008 to present day. So how I'm playing this is I'm basically going long on the SPY until I see the price touch these moving averages. Once I see the price touch the 100 period moving average, I'll be looking for weakness in the market in order to take profit on that, and then I'll be switching short. For this week, however, I am still short very briefly, betting on more downside and chop for stocks like Tesla, Apple, and the Qs. I still have a net short position on the Qs that I'll be looking to take profit on shortly. Right now, the Qs are actually still just a little bit red after last week. We haven't quite retested the lows here, so I think that the Qs will maybe see a little bit of downside tomorrow. I'll be taking profit on those short positions and then looking to go long in the tech sector after seeing those rally. Looking at the stock market heat map, we can see that literally everything in the NASDAQ as well as on the S&P 500, we had green across the board. The only thing that was red was Tesla, which is down 8%. So Tesla, I'm still net short on, but I'd be looking to take profit on those quickly and then average down some long positions. I'm kind of playing the market both ways, looking to take profit on anything that's short in the short term and then average down in the long positions for the long term. And how I'm playing that is basically I've got some SPXU calls, which is a short leveraged ETF against the SPY. Those are expiring this Friday. So I'm expecting the SPY to kind of do this and create a double bottom and then bounce afterwards for us to complete this rally. And I expect that to end sometime in mid-October. The long positions that I have expire the 21st of October. So this is where I will be at the very latest closing my short legs, and this is where I will be expecting to take profit on my long legs. So kind of playing the market in both directions, hedging for some downside risk while I'm going net long in the market for the rest of this next 2 weeks, playing this MACD crossover and the RSI bullish divergence. And we'll see how it goes. What I want people to be careful of is not to get too overzealous playing the market in a single direction for too long, because, you know, this stuff turns around. It chops. It's what it does. And we've been on this move for a long time. Like, remember what people were saying at this point where Apple was pumping like crazy and the market had gone up all this way just so unexpectedly. And so many of us got rug pulled when the market bottomed here and we were still going short, and I was still going short, and I didn't exit my short positions until up here. And it was murder, man. So I want people to avoid that mistake again, because we have a lot of intersection, just a whole bunch of these candles that are they're just clustered together, and you can see that happened before. So try to be careful and expect a lot of chop in the market. Don't get too greedy with any position. Take profits where you can get them, and don't stay in any one position for too long. Once I see the market start to relax a little bit, the VIX is still above 30 right now, but I have a feeling that the VIX is going to come down to retest its moving averages right here. We have yet to make a bullish golden cross on the VIX, which would be this green 50 daily moving average crossing above the red 200 moving average. Once we see this signal, then I know that the market is going to experience some supreme fear, and that would be bad for the SPY. So that will be one of my signals to watch for, that the market is getting prepared to turn back to the downside in a couple of weeks. But for right now, it would appear to me that the VIX is going to cross down on the MACD, go back to the downside. The RSI will cool off. We'll see some consolidation and chop in this area before the VIX is ready to go off onto another leg. Note that we've been testing and testing and testing these resistances, and we've finally tested this outer resistance for the 1, 2, 3, 4, 5th time. So this is a significant touch, but we need to get a clear breakout. We didn't get a breakout of this one until we had a candle close above. As soon as this candle closed above, we saw the market just taking off to the downside. So we need to see something like that again before we're ready for big time crash mode. For those that were tracking my housing market plays, I've also closed my short position on XLRE, so I'm no longer short the housing market for the time being. I'm actually expecting this to turn around and go long, but I don't want to stay long in the housing market. So rather than going long in XLRE, what I'm doing is going short on DRV. DRV is the leveraged index that tracks XLRE, and essentially whenever XLRE goes up, this thing goes down. When XLRE goes sideways, this thing goes down very slowly. So in the event that XLRE doesn't really go up, it just kind of chops sideways, DRV will still go down. So that's how I'm playing this. So I opened up some puts on DRV with a price target in the low 50s. And what I'm anticipating is for DRV to slowly bleed off, and we'll get this rapid descent in DRV, kind of like how we did before. The market didn't really turn around really quickly, but DRV bled off anyway, just because this is a highly leveraged ETF that's subject to drift, and I'm going to try to take advantage of that to get some profits where I can. And that will allow me to build up a small amount of cash on the side as I wait for the big crash to come next year in the housing market. Another sector that I'm going to be looking to go long in is the energy minerals sector, particularly in Exxon and Chevron, as well as Occidental Petroleum. So these three stocks, starting with Exxon Mobil, this one kind of rug pulled us on this bullish pennant that didn't play out. This one kind of unexpectedly took a trip to the downside after it failed to break out of this resistance. So now the bull flag has kind of reformed itself. It's still consolidating a little bit. However, we had this nice clean bounce off of the 200 period moving average. So it did cross for one candle here, and then immediately it turned around on this gap up indecision candle. And then we had a big boom boom candle right after that. Currently, Exxon is getting a little bit more resistance, but if you look closely on this on the 1 hour chart, you'll find that it's actually forming what looks to be a little bit of a bull flag, and then it had gapped up and broken out. So Exxon Mobil looks like it's ready to start retesting previous highs. I wish that I had seen this little inverse head and shoulders pattern. We had this nice inverse head and shoulders pattern that might have given me a clue that we were heading up to the upside again. But what can you do? You can't watch everything all the time in the market. US oil is what would have given us the clue that this was taking place, because US oil, I don't have its moving averages on here, but US oil also hit a 200 moving average right here, and it was part of a much larger bull flag. And what's more, it bounced off of previous resistance for the fourth time, and we've seen that every single time that it's bounced off of this resistance line, it's gone on for bigger and bigger runs each time. So with the latest one, seeing a 16-17% gain in just 200 days, I'm looking to go long on Exxon for the rest of the year, expecting for oil to pump its value as oil continues to rise in price per barrel. So for Exxon, this looks very promising. I'll be looking to go long in Exxon to the 95 price level. Hopefully there will be a little bit of downside. We will fill this gap and get a little bit of a better entry down in the high 80s area. If I can get a nice entry to go long in this sector, we'll be looking to take a little bit of profit as we touch resistance on this bull flag, and maybe leave some runners for another take profit above 105. Let's take a look at Occidental Petroleum, which also was printing a very similar pattern. Occidental Petroleum also was throwing some bottoms right here. We had a brief undercut, an indecision candle, and then a big green engulfing reversal candle to the upside, as well as a couple of a little bit of consolidation here. So I'm going to be looking for Occidental Petroleum to push up a little bit further tomorrow, but I am kind of hoping that it will fill this gap to the downside and I can get a nice entry right here as it retests the 50 period moving average on the 2 hour chart, or the 100 on the 1 hour chart, depending on which chart you trade. And then the Chevron Corporation, which is another American gas corporation, it's been heading to the upside all day long. It basically hadn't given up until the very end of the day when it tested its 200 period 30-minute moving average, and this actually had formed a bit of a ascending wedge, which barely broke down to the downside on. So I'm hoping to see Chevron drop back down, retest these moving averages, and then be able to get an entry to the long side. My reasons for taking this bet is that essentially oil is going to keep going up in price, and I don't think that inflation has quite peaked yet. And at the very least, the demand for oil is going to cause prices to rise in the near future. The Fed is having a hell of a time fighting it. And now with rumors that there's going to be a central bank pivot across the EU and possibly with the US Fed, although I'm hoping that they don't, I'm really hoping that they stick to their guns for the sake of the economy. I have to acknowledge that they will at least consider it if just because the Bank of England is begging them to. They may not stop. They may not stop raising interest rates entirely, and they're probably not going to lower the rates, at least not yet, but they may stop raising rates for the rest of this year because the Bank of England is asking them not to. So the Fed may reverse its decision to raise the interest rates by another 75 to 125 basis points before New Year's. And if that happens, then yes, stocks will probably pump for the short term. But it will have disastrous effects later on down the line. Covering the macros one last time, we can see that the dollar index is retracing pretty severely. So this is making the dollar a little bit weaker. This is something that the stock market likes to see as equities become a better investment vehicle and people exit their cash positions. The dollar will retreat. The high yield government bonds are also putting in higher lows, so there's some divergence here, and we broke this bear flag pattern. We were printing a bear flag for the last, honestly, we have been printing this pattern for about 2 weeks now, starting on the 23rd of September. So now with this new pattern established, I'd be looking to see HYG break out, and if it does break out, that would confirm a SPY rally. I think we will have to test the low one more time, however, before that breakout occurs. And that would coincide with my bet for a short-term downside for the rest of this week, or at least for the next couple days this week in the S&P, but for a longer-term rally to the upside going into mid-October, at which point I would anticipate HYG returning to about 75. I'm not playing HYG, but I do use it as a leading indicator of what the SPY is going to do. So keep an eye out for that. Tesla was a pretty severe drop as well, so I'm only calling this out because I know a lot of people trade this fishhook pattern that I watch. So this does look good for a downside bet, at least to the next level of resistance at around $230 would be my last take profit here for one more downside move. But the MACD did cross above on several of these moving averages. It's still showing weaker on the daily, so the MACD is moving lower on the daily. And that would indicate that Tesla has a little bit farther to go. And coinciding with that bet, we do see that this candle broke below rising lows. So this is now it's still a higher low, but it's broken the trend line. So I would anticipate Tesla at least putting in a few lower lows. This is likely in anticipation of Tesla's earnings, which are expected to be extremely poor due to the loss of their overseas factories. Nvidia is beginning to curl around, and we've had the MACD consolidating as well as a big cross. The RSI is showing repeated bullish divergence here and here. So higher lows on the RSI, lower lows in the price. That indicates a bullish divergence for Nvidia. And if this does play to the upside, then Nvidia could reach previous resistance somewhere around the 160 to 170 level. That would bring them back up to just under where their earnings had sat before. It's a bit of a tall order, but if the market does rally, Nvidia is going to be one of those stocks that goes far fast, just because the fiscal policy decisions were pretty severe and hampered Nvidia's performance very badly. As well, China threatening to go to war with Taiwan over reunification and all that nonsense. So everybody's still pretty spooked by that, and that was one of the reasons why Nvidia sold off so heavily. But now Nvidia is trading at very nearly the bottom of its chart. So this support is very strong at 120, and it will be very hard for Nvidia to break that. Netflix is also putting in higher lows. We've got another MACD cross to the upside. This consolidation that we've been in for some time has basically formed a very bullish structure for Netflix. And after selling off so much repeatedly this entire year, Netflix has had two major gap downs that I would be very careful of. If you're short Netflix. A lot of people are still short Netflix, but at this point, they're so badly oversold. And now this structure is testing the lows. It's tested it 3 times. And I think that on a 4th test of this gap, Netflix will take it. So this could be a big opportunity to take some very significant profits. If we see Netflix pump as a result of increased interest in streaming and internet services, as well as a Fed pivot, or at least a cessation of interest rate hikes for the rest of the year, then I think that Netflix will probably see at least some bullish upside for the rest of October and the holiday rally in December. So it may take some time, but this is one that I would say is worth taking a risk on. The risk to reward for Netflix is pretty good going out to January. Keep in mind, like this is a difference of $60-$80. So the potential risk to reward ratio here is very nice. You could set a stop here at the 215 level, and that would put you at the bottom of this structure. And you can play this to 320, 330. Even 320, you're still getting a 3-to-1 risk to reward ratio on Netflix. That's just for stock. If you go in out the money options on this, just call options, there's a very good risk to reward ratio here if Netflix does end up retaking this gap. Those are a few of my bets. I'm going to stay away from the banks. I think that they will pump, but I'm just going to stay away from them because I don't know what they're planning. Amazon is put in another higher low. So we had lows down here, higher low here, and at this point I'm expecting Amazon to print another run to retest this previous high. So all of this will most likely see Amazon pushing to new heights for the holiday rally. They'll probably see a nice boost in their sales as well, so that's going to affect their sales figures, and of course the stock market will love it. So expect Amazon to start seeing some bullish momentum as well. Apple, I'm still overall bearish on, but I think that they need one more rally, one more retest of their 200 moving average before the stock market gives up on it entirely. So for the time being, I'm expecting Apple to rally at least to the 100 moving average, possibly to the 200 moving average at around 160 before finally giving up after earnings, because I'm anticipating that their earnings sales are going to show a huge decline in their sales volume and a decline in prices, as well as a rising cost of semiconductor metals and parts. All of this will translate to reduced revenue for Apple, coinciding with increasing expenditure, and they've already absorbed a bunch of debt by selling corporate bonds to the market a few months ago. And while Apple will probably do well over the long term, over the next 5 years, they'll probably be one of the first stocks to recover after this crash. I do think that they will be the ones to finally send us tumbling over the edge. That's going to be it for this update video. Thank you guys so much for watching, and I look forward to seeing you tomorrow at the bell. Have a hell of a time in the market.